FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz, and well, we're recording this show on 3/9. You are going to be hearing it on 3/10. John Rubino is with us to discuss the latest fallout in the markets, and boy, are they falling out. Right at this moment, the Dow is down 1,331 points. All the circuit breakers have tripped. Trading has been halted in a number of markets in the futures for sure. So you're not getting that arbitrage to further drive the markets down. Gold's down $7.50 from being up $28 earlier in the day. Gee, funny how that works. Silver down 45 cents, and gold to silver ratio 98.5 to 1. Man, you're looking at 100 right around the corner. Well, let's hear what John Rubino has to say about it. Make sure you go to his site, sign up for his newsletter, dollarcollapse.com. John, so I was going to say happy Monday, but it's a good thing that all those windows in the buildings in Wall Street, downtown Manhattan are sealed now. Otherwise, you'd have bodies jumping out there, right?
Hey, Kerry. Yeah, there is action in the financial markets this morning. This is the kind of thing it doesn't work for me personally, though, because when the futures blow up the night before, it always interrupts my sleep. I'm always picking up my phone and looking at it, and in the middle of the night to see what's happening. And this was one of those nights. So now I'm kind of groggy. But basically what has to happen now is the financial markets have to flake out until the Fed comes in and does something big, because that's our pattern where the system is clearly unworkable. Even if you take out the coronavirus from the equation, we would still be heading for something like this, just because of the buildup of debt and all the instabilities that are out there, other than the pandemic. But so now we've found in the pandemic a pin that can immediately pop the bubble. The bubble is popping, and without the circuit breakers, as you mentioned, the stock market would be down a lot more than it is now. It's down like 1,200 points on the Dow, which is a big deal, but not out of character for the last couple of weeks. We've had some 1,000-point days up and down, and interest rates are plunging. The whole thing, the whole end of the financial world thing. And so they're sitting around in D.C. right now, trying to decide what the Fed is going to do and what the central government is going to do to try to stop this, because it won't stop until something big happens financially, in terms of the Fed coming in and buying equities or who knows what, or the federal government announcing $1 trillion infrastructure program, whatever. I don't know what it would be right now, because it's not clear what it's going to take to stop the bleeding, if there is anything. Because the end game out here, as we've talked about so many times, is that there will be a financial crisis. The government and the Fed will step in and try to stop it, and they'll fail. It'll turn out that they don't have any tools left in the toolbox that can stop something like this, and then all hell breaks loose. Then we realize that the system is blowing up and we can't stop it. And that's when things get really interesting from the old Chinese curse point of view.
Yeah, living in interesting times.
Because it's not clear what the Fed could do to stop this, because they can't, by lowering interest rates, take Italy off of lockdown, right? Italy, 1/4 of the Italian population is in quarantine right now. And there's not much slightly lower interest rates can do about that. And it's the same thing around the world. We've got turmoil that isn't immediately fixable with financial tools, or maybe is just absolutely not fixable on any time frame with financial tools. And so it's going to be interesting to see how this plays out, because stocks are wildly overvalued. There are air pockets under, especially big tech. They could fall 50 or 70% and be fairly valued, not even be undervalued at that point. And real estate is the same way. So a lot of things could happen in terms of market crises that are just what should happen based on valuation, but it's going to seem like the end of the world to most people who are long in the financial markets right now. So that's what we're headed for.
Hey,
it's not clear how it works out.
Look at what's happened to the yield curve. We had the record low on the 10-year, which went down to, 0.318%. That's the lowest ever. And the 30-year, I think, went below, if I'm not mistaken, the 30-year went below 2%. Maybe it's down to 1. These yields are like, forget it. Talk about a flight to safety, and yet gold is down. Go figure that one out, huh?
Yeah, well, gold is down, but not dramatically down. So it's attracting some safe haven money too, but it's also attracting some selling on the part of people who are getting margin calls and stuff. You gotta sell your gold stocks even though they're up. If your tech stocks have tanked and your broker is threatening just to randomly sell stuff off, so you're going to go in there and sell things where you've got a little bit of an embedded profit, and that's what's hitting gold mining stocks, and to an extent gold, and that's also historically normal. We talked about the 2008 precedent in our last interview, where everything fell, including gold and silver, but it was a V bottom where they tanked and then they jumped right back up off the bottom and took off when the Fed started flooding the system with cash. It wouldn't be a surprise to see that happen again here, but again, it's not clear what the Fed is going to come up with and what it does. But on interest rates, one more week like the last week, and we are in negative interest rate territory across the entire yield curve in the U.S. And what a change, man. We were the country with positive yields on the long bond and everything, unlike China or unlike Germany and big chunks of Europe besides Germany and Japan and some other parts of the world, where interest rates were negative all the way out to 10 years, and all of a sudden we're joining that club. And we're doing it in a heartbeat, just boom. Not even because of any real Fed action or anything. We didn't come in with some kind of a QE twist program to push long-term interest rates down. They just collapsed. And that's a very big deal. When you see a spontaneous collapse of long-term interest rates into near negative or even negative territory, that's a sign of extreme stress in the financial markets. And that's what we're seeing right now. So again, it's not clear exactly how this plays out. It's not clear how the governments of the world respond to it. But I got to say the best case scenario, let's take a look at the best case scenario right now, which is still pretty grim. But let's say that the coronavirus disappears like Trump said he hopes it does. When the weather warms up, the virus goes away. I think he used the word miraculous in his press conference when he was talking about it. But let's say that happens. Let's say by June, this whole global pandemic thing is pretty much over. Will the world then go back to the old normal of just-in-time inventory systems and free trade and multi-country supply chains? And I think probably not, because the psychological damage has been done. We have found out how fragile this system is. And if you're, say, a corporate CEO, for instance, and you've got a fiduciary responsibility to protect your shareholders' money, your shareholders and your board of directors are going to want you to take steps to minimize the risk that we now know exists in just-in-time inventory systems, for instance, and supply chains where you're mining stuff in 10 different countries and sending the raw materials to 4 different countries for processing and sending the components that are produced to several other countries for assembly before you ship everything to your final markets. It's clear now that a break in one link in that chain can shut down the whole thing. So big multinational companies now have to deal with the realization that they're carrying excessive risk in their current business model. And so they've got to bring some manufacturing back home. They've got to simplify supply chains. They've got to build up inventory now. They've got to start holding actual inventory instead of just assuming it'll show up tomorrow to cover that day's production. Yeah. And what that means is that we'll be pulling a lot of work away from China, which had basically bet the farm on being the world's manufacturing platform. And which borrowed an insane amount of money to make that happen. So you've got hundreds, if not thousands, of Chinese companies which are already on the verge of bankruptcy, and which probably won't be saved by the disappearance of the coronavirus, because once the virus disappears, you'll see a lot of customers pulling their work out of China and trying to bring it back home. And you've got all these Chinese municipalities that borrowed crazy amounts of money to build out the infrastructure to make all this happen. And that infrastructure is not generating, even now, is not generating enough cash to cover the related debt. So let the crisis go on for a little while longer, then resolve, and then let big multinationals pull out of these Chinese production facilities in the big cities that have built up around them. And you'll see a Chinese financial crisis when all of this debt has to be dealt with somehow, but they don't know how to do it, and that alone is enough to cause a global recession, and maybe something much worse, because China is the number 2 country in the world in terms of the size of its economy, and it quadrupled its debt in the last 6 or 7 years, which means that it is extremely over indebted. A lot of that debt is in U.S. dollars, so the potential for turmoil in the financial markets, if China has a crisis, even if everybody else is basically back from the brink, is still pretty big. And I think that's the best case scenario, a Chinese financial crisis, which sends us into a recession, which could be a depression if we don't watch it. And that's the best we can hope for. It could be much, much worse than that. Well, so suddenly we're in big trouble here.
Yeah. Well, it's obvious. It's going to be an issue. Going to be a problem for a while. One thing that's interesting is it seems like in the warmer areas, there's less cases than in the hotter areas. I should say the cooler areas. In New York, they just hit 150 some odd cases. Florida has 18, of which people came from other countries and brought it. New York's having community spread. So supposedly the epidemiologists, they don't really know why, but a theory is that when it's hot and humid, your saliva particles, when you sneeze and such, don't go for as far because there's a resistance in the air, and instead they fall to the ground. I think there's also more light going on, more UV rays to kill these viruses, more sunlight. I think there's something to it as well, but nobody really knows. This is a theory that sounds pretty reasonable, but who the heck knows? But John, these rates are the ruination of the financial system. It's kryptonite. I don't think they're going to allow the U.S. to go negative, but I can see Fed funds go into a quarter of a point, 25 basis points. What about what's happening in the repo? The Fed keeps upping the amount of the temporary bailout of that market every single day. And if you remember, we talked a couple of months ago, some reports said that JP Morgan Chase had pulled out of the repo market, basically took 100-something billion out. Nobody knew why. And that basically left the Fed there to pick up the pieces, which they have done, and have done, hundreds of billions of dollars worth of done. Now we see with all the redemptions and everything, obviously these hedge funds have had to have been under tremendous pressure, John. There's got to be tens, hundreds of billions of dollars worth of redemptions in these hedge funds. And now JP Morgan Chase's behavior on this issue becomes very, very rational, doesn't it?
FSN Radio. It's all about what's next.
Arcana Corporation is on the verge of bringing the world's highest grade silver mine into production. The Revenue Virginius mine in Colorado has proven improbable silver reserves grading nearly 37 ounces per ton silver, with an all-in sustaining production cost of only US $8 per ounce of silver. The mine is fully permitted with infrastructure already in place, and the company has announced they plan to commence production in 2020. Achieving successful production usually results in a significant upward share price re-rating on the Lassonde curve. Arcana trades under the ticker AUN in Toronto and AUNFF in New York. To learn more, go to arcana.com. That's AURCANA.com.
The Financial Survival Network. It's all about what's next.
Well, rational for them.
Yeah.
But not positive for the global financial system. When you got big players just pulling out of things that require the participation of everybody to function, and if they don't function, the system just collapses. Mm-hmm. That's another thing where we're seeing the risk inherent in the way we were doing things before, and are going to want to pull back from that risk. In other words, to change the system in some way that makes it less risky. But that's hard to do when you're over leveraged. If you recognize that you've got too much debt, it's not clear. It's much clearer to recognize that you've got too much debt than it is to figure out what you need to do about your problem. Because trying to pull back risks cratering the whole system. There's that famous quote from, I think it was Hayek, the Austrian economist, that there is no solution after you create a debt bubble. You only have a collapse. That's all you can do to get out of it, because there is no way to ease your way out of something when everybody is wildly over leveraged and they require more and more credit to keep going, because that's where we are now. We need $3 or $4 trillion of credit just in the US alone each year in order to keep the system from imploding. So for us to say, well, we need to scale back on our borrowing because we're building up too much debt, means that we're taking on less credit and we're going to implode the system. So that's where we are now. We've reached the point of no return. Actually, we reached the point of no return a long time ago. Yeah. And somehow we kept plodding along forward, taking on more and more debt, far beyond what we should have been able to. Really, you can make the case that when the tech stock bubble burst in 2000, that was the end of the fiat currency fractional reserve banking system, or it should have been. And yet we managed to keep this thing going for another 2 decades, but at the cost of so much more debt and so much more leverage at every level of every major society that there's no way out now. Not that there was an easy way out then. We would have had to have a really, really deep recession in 2000 with a huge deleveraging on the part of corporations and consumers and governments. That would have been brutal, would have been multi-years, many years of pain for everybody involved, just about. And we chose not to take the pain then and to push it off into the future. And now it's magnified dramatically. Now it's orders of magnitude more pain than it would have been back then. And so the Fed is going to try something. They've learned one lesson over the past 30 or 40 years, which is that you meet crises with easy money. Mm-hmm. And that gets you through the immediate crisis. And then you worry about what to do after that. You stop the bleeding, and then you worry about how to change your lifestyle. But they never got to that point. They would just stop the bleeding and never changed the way the global financial system worked. They just loaded it up with more and more debt. So now we had this exogenous shock. We had a global pandemic that has basically shut down big parts of the global economy. And people starting to recognize that the way it was working before obviously wasn't the right way for it to work if it's this easy to shut it down, right? Because it didn't have to be a pandemic. It could have been a war somewhere. It could have been a couple of big financial institutions just imploding. It could have been any number of things. That Cat 5 hurricane that finally is going to hit Miami. It could have been lots of different things that started us down the path that we're on now. But it happened to be a disease that sprung up out of nowhere and shut down parts of the global economy. But the pin was always coming. Something was always going to burst this bubble, and now it's bursting. And, from an economic theory standpoint, it's fascinating to watch these guys flail around and try to do something about it. But it's not at all clear that they can fix this. And we're going to find out what they're going to try shortly. I mean, it can't be much more than a few days before the Fed announces some really big, crazy new piece of financial experimentation. And we'll see how the markets react, and we'll see how it works in the intermediate term. But it isn't clear now that there's anything left that fixes what's wrong.
Yeah, I don't see how you get Humpty Dumpty, put him back together again. He's fallen off the wall, and all the king's men and the king's fed cannot do it. But on the other hand, John, we were expecting this to happen 10, 11 years ago, and they managed to reflate the bubble, and they kept it going, John, for actually 11 whole years. That in itself is a Herculean task. I don't think that we're better off because they let it happen. I think we're probably worse off because all the bad behavior that led to the first crash was encouraged and actually amplified by the bailouts. So rather than learning anything from the entire meltdown initially, we learned absolutely nothing. And that reminds me of that saying, you've heard me use it many times on the show. We've forgotten nothing and we've learned nothing, or we've learned nothing and we've forgotten nothing. We've learned absolutely nothing and we've forgotten nothing. And that's where we're at now, right? I mean, we've learned absolutely nothing.
And Kerry, we forgot to talk about oil so far.
Oil,
which is maybe one of the biggest stories out there right now. Oil just tanked.
Yeah. Let me just get the reading on oil right now. And we're doing this in the afternoon on the 9th. You're listening to it on the 10th. But oil is down 33.92, down $7.50 a barrel. Copper's actually holding up pretty decent. It's at $2.50. It really needs to be at $3.50 to really get the supply that the world needs. Whatever happens in this meltdown, John, nothing is going to change about the increasing demand for copper. It's going to happen because it's just going to keep going up. And the demand for oil will go up too. I wonder, hey, you know what we forgot to talk about, John? One of our favorite bellwether bubble stocks. And you know what I'm talking about. Tesla. It was at almost 1,000. Now it's down to 635. Remember, it double topped. And if you were in Tesla, that was the time to get the heck out when it hit that double top. My feeling was it was going to go to 1,500, and it probably would have, but for the precipitating cause of the coronavirus driving markets down. But that's neither here nor there, because now we're at 635. It's lost 350. It's lost more than a third of its value, John. And I guess it was a good short after all, but you had to have a stone-sized set of nads to do that one.
Mm-hmm. Yeah, I found out that was a volatile market to be shorting, but it did work out in the end. But the oil thing is a big deal, though, because it looks like the actual motivation of Saudi Arabia now cutting oil prices the way they did was to basically close down the U.S. shale oil market. Because that's the only way to take supply off the market from the Saudis' point of view, because they couldn't engineer an OPEC production cut. They couldn't get enough countries to agree to it. So now they're going to force prices down and take out a lot of our production capacity, just, make it uneconomic for these shale oil wells to keep operating.
I don't think it's going to work because the cost of producing the oil from shale keeps going down and down. And they keep finding new ways to produce it cheaper. But obviously that is the intent. They
finance themselves with junk bonds, which means they have a need to generate a lot of cash flow up front to cover their interest costs. And I think we could easily see a lot of carnage in that market. And the question is, does it spread beyond energy-specific junk bonds into other parts of fixed income, which would mean that spreads would blow out in the fixed income market. In other words, the difference between the yield on a treasury bond and the yield on an oil patch junk bond would go to double digits, to some crazy number. And that usually precedes a recession when some sector of the economy sees its debt spreads blow out. And so that's another thing that is affecting the economy. It's hard to think of these little things like this as important factors in the economy when you got a big thing like a global pandemic. But, a blow up in some fairly large sector of the fixed income market is nothing to sneeze at. That's a big risk out there.
Big risk. And What it's going to enable us to do, I think, is for the majors to take up more of those properties. Oil will go back up again, but it's going to stay down for a good 6-8 months, and that could be the nail in the coffin for a lot of those marginal operators. We're just going to have to see, and we're going to see where everything heads when we talk next week. It's really going to be interesting to see what the intervention is going to be, how the coronavirus is going to spread. One thing that the theory that it's going to diminish in the spring is there's very good science behind it, but they're not encouraging people to think that because they want them to stay vigilant now. And if you say, in 4 weeks it'll be gone, then that's not really going to accomplish their goals of control and whether it's control of the populace, John, or control of the disease, or maybe it's one and the same. I don't know. There's a lot of theories about it. I'm sure you've heard them. It enables, never let a crisis go to waste, right? So anyways, make sure you go check out John's site. He's got articles coming on this topic regularly throughout the day. It is dollarcollapse.com, and sign up for his newsletter. Sign up for ours at financialsurvivalnetwork.com. As always, we welcome your comments, your feedback. Where do you think this thing is heading? Where do you think the coronavirus is heading? Where is gold going? Oil? All these things. What's your opinion? Don't just tell us your opinion. Tell us why you think that. The email address is kl@kerrylutz.com. Our Twitter feed's at Kerry Lutz. Facebook page is Financial Survival Network. And John, we'll catch up with you next week.
Great. See you, Kerry.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.